Hey there, investors. Welcome to an exciting journey into the world of high-growth stocks. Are you ready to supercharge your portfolio and take your investments to the next level? High-growth stocks are your ticket to financial freedom, offering the potential for substantial returns. These babies are the Ferraris of the stock market, designed for speed and performance. They leave the competition in the dust, accelerating your wealth faster than you can imagine. We're talking about explosive growth, folks. The kind of growth that can make your portfolio skyrocket. The kind of growth that can turn a small investment into a massive fortune. But hold on, it's not all about luck. Picking high-growth stocks isn't about throwing darts at a board. It requires careful analysis and a strategic approach. It requires knowledge, strategy, and a little bit of that Kramer instinct. You need to understand market trends and company fundamentals. Don't worry, I'm here to guide you through this complex yet rewarding journey. We'll dive deep into the world of high-growth stocks, exploring the factors that drive their performance. Get ready to learn the secrets to spotting these winners. We'll cover everything from market analysis to company research. We'll look at how to read financial statements, understand earnings reports, and identify key indicators of growth. You'll learn how to evaluate a company's potential, considering factors like revenue growth, profit margins, and market share. We'll also discuss the importance of diversification and risk management, ensuring you build a balanced portfolio. And remember, patience is key. High-growth stocks can be volatile, but with the right strategy, you can ride out the ups and downs. So, buckle up and get ready for an exhilarating ride. The world of high-growth stocks is full of opportunities, and with the right knowledge, you can seize them. Stay tuned as we uncover the secrets to high-growth investing and help you achieve your financial goals. Together, we'll navigate the exciting world of high-growth stocks and unlock the potential for incredible returns. Let's get started on this thrilling journey to financial freedom. So, what exactly are high-growth stocks? Simply put, they're companies that are expanding at a rapid pace. Think of a rocket ship blasting off into space. That's the kind of trajectory we're looking for. These companies aren't content with just staying afloat. They're disrupting industries, innovating like crazy, and raking in profits. They're the movers and shakers, the game changers, the ones to watch. Now, let's get down to the nitty-gritty of identifying these high flyers. First up, we've got earnings growth. Earnings growth is a critical indicator of a company's financial health and future potential. It shows how well a company is increasing its profits over time, which is essential for long-term investors. This is the bread and butter of successful investing. When a company consistently grows its earnings, it not only demonstrates its ability to generate profit, but also its potential to reward shareholders with higher returns. We want to see companies growing their earnings per share at a healthy clip. This means that the company is not just increasing its total earnings, but also ensuring that each share of stock becomes more valuable over time. Why? Because higher earnings mean higher stock prices. When a company reports strong earnings growth, it often leads to increased investor confidence, driving up the stock price and creating wealth for shareholders. Take Reliance Industries, for example. This company has become a prime example of how strategic growth and diversification can lead to sustained financial success. This Indian conglomerate has been on a tear, consistently growing its earnings year after year. Their strategic decisions and investments have paid off, making them a powerhouse in the market. They've tapped into multiple sectors, from telecom to retail, and their profits have soared. By diversifying their business operations, Reliance Industries has mitigated risks and capitalized on various market opportunities. That's the power of earnings growth, folks. It's not just about making money today, but about building a foundation for future success. Companies like Reliance Industries show us that with the right strategy and execution, consistent earnings growth is achievable and can lead to significant long-term rewards for investors. Next, we have revenue growth. Revenue growth is a critical indicator of a company's health and potential for future success. It shows how well a company is performing in terms of generating income from its operations. When we see a consistent upward trend in revenue, it means the company is effectively meeting market demands and expanding its customer base. This is a positive sign for investors and stakeholders who are looking for sustainable growth. It's not enough for a company to just control costs. While cost control is essential for maintaining profitability, it doesn't tell the whole story. A company must also focus on increasing its revenue streams. This involves innovating, expanding into new markets, and continuously improving products and services to attract more customers. Cost control and revenue growth must go hand in hand to ensure long-term success. They need to be bringing in more money. Generating higher revenue is crucial for a company to invest in new projects, research and development, and to stay ahead of the competition. It allows the company to scale its operations, hire more talent, and enhance its market presence. Without a steady increase in revenue, a company may struggle to sustain its growth and could eventually fall behind its competitors. We want to see revenues climbing steadily, indicating strong demand for their products or services. This steady climb in revenue is a testament to the company's ability to adapt to market changes and to innovate continuously. It reflects the company's strategic planning and execution, which are essential for maintaining a competitive edge in the industry. Investors and analysts closely monitor revenue trends to gauge the company's performance and future prospects. Look at Infosys, another Indian giant. Infosys has set a benchmark in the IT consulting industry with its impressive revenue growth. The company has consistently demonstrated its ability to leverage technology and innovation to drive business success. Infosys's strategic initiatives and focus on digital transformation have played a significant role in its revenue growth. This IT consulting firm has been riding the wave of the digital revolution. By embracing cutting-edge technologies and offering innovative solutions, Infosys has positioned itself as a leader in the industry. The company's commitment to digital transformation has enabled it to meet the evolving needs of its clients and to stay ahead of the competition. Their revenues have skyrocketed as businesses around the world seek their expertise. Infosys's ability to deliver high-quality services and solutions has earned it a strong reputation and a loyal client base. The company's global reach and diverse portfolio have contributed to its impressive revenue growth, making it a preferred partner for businesses looking to navigate the complexities of the digital age. That's the beauty of revenue growth. It's a sign of a company that's in high demand. When a company like Infosys experiences significant revenue growth, it indicates that its products and services are highly valued in the market. This not only boosts the company's financial performance, but also enhances its brand reputation and market position. Revenue growth is a clear indicator of a company's success and its potential for future expansion and innovation. Now, let's talk technicals. Moving averages are like a trend-spotting superpower. They smooth out price fluctuations, giving you a clear picture of where a stock is headed. Imagine you're looking at HDFC Bank's chart. See how the price stays above its 50-day moving average? That's a bullish signal, my friends. It means the stock is in an uptrend. Keep an eye on those moving averages. They'll keep you on the right side of the trade. Section 6. Riding the momentum wave with RSI. Another powerful tool in your technical arsenal is the Relative Strength Index, or RSI. This oscillator measures a stock's momentum, telling you if it's overbought or oversold. Take TCS, for instance. When its RSI dips below 30, it's a screaming buy signal. Why? Because the stock is oversold and likely to bounce back. Use the RSI to time your entries and exits. It's like having a crystal ball. Iyan uti bain pomtoke. Section 7. The power of two fundamentals meet technicals. Now here's the key, folks. Combine fundamentals and technicals for a killer strategy. Don't just rely on one or the other. Use them together to get a complete picture of a stock's potential. Find companies with strong earnings and revenue growth, then use technical analysis to confirm your findings. Look for stocks with upward trending moving averages and healthy RSI readings. That's how you separate the wheat from the chaff. Section 8. Your path to high growth success. Let's recap. We've talked about the importance of earnings growth, revenue growth, moving averages, and the RSI. These are your building blocks for identifying high growth stocks. Remember, investing is a marathon, not a sprint. Don't expect to get rich quick. Be patient, do your research, and stick to your strategy. The rewards will come. Section 9. Time to invest. Your financial future awaits. Now, go out there and start researching. The stock market is full of opportunities. Don't let them pass you by. With the right knowledge and a little bit of hustle, you can achieve your financial dreams. Remember, I'm here to cheer you on every step of the way. Now go make some money.